Let's bring in Liz Young, Director of Market Strategy at BNY Mellon Investment Management, now down about 100 or so. Liz, is in looking at your notes, I'm not sure you're sure what investors should be doing at this point. We're at the beginning of a bottoming process. Expect a lot more, perhaps downside based on what happens with the virus. But start thinking about certain areas that look that might be attractive down the road. Is that sum it up for you mostly, or?
That's a pretty good summary. Hi, Joe. So I think what I would start with is you can't separate the market and economic data from the health data here. And we still have so much uncertainty. We haven't hit a peak yet. We're hopeful that we're going to hit a peak in the virus mid-April in New York and then maybe later April across the country. Once we get on the other side of that mountain, then investors can be a little more certain. The reason why it's a little convoluted right now about dipping your toes in is because we had, as you know, 3 days of gains last week, and everybody wanted to call the bottom. Everybody wanted to say Monday was the bottom. I don't know that we can do that yet. Even if that is the furthest we go down, peak to trough, I don't think we're just, out of the woods and going to continue going up on a trend here going forward. So there's going to be more pain to come, and it depends on how big your threshold for pain is.
Because, Liz, the previous breaks that we've seen have been more significant, 2008 or even 1987, and we've had a big break, 30 plus, mid-30s, whatever it is, but others have gone almost 50 or so. If you could decide, in other words, we're still a fair amount above the lows that we've set. So we'd have to go down another, 10, 12% right now to get to the lows, and then add another 10, 12 on there before you're not getting too cute. You know what I mean? I mean, if we only go back down to the lows and then 5% below that, long term, you could make a case that that some of these prices might be good entry points. You can't call the exact bottom. Only if you thought we were going to set really, really significant new lows would you have to, not average in at least a little bit at this point. Or is that wrong? Do you just totally step aside?
That's fair. So here's the numbers around it. If you have an investment time horizon that's more than 24 months, because on average, we get back to the kind of range that we were before a crisis within 24 months, but there's still outliers to that. And when you look at what the lows are, what the peak to trough decline is without a recession, we're about in that range right now. So we compare a lot to that 1987 crash. That pullback was 33%. So far, the biggest pullback we've had here was 34%. So if we don't go into a recession, this feels like enough. If we do end up going into a recession, it's typically deeper and longer lasting. So as you pointed out, 2000 and 2002 was about 49% down. 2008 was closer to 57, 58%. So if we do have a recession, which we still don't know, if we do have a recession, we probably have more to go. But that doesn't mean that you can't start thinking about dipping your toe in the water here, because, again, you don't want to miss the whole thing. And even if we do retest and go 5% below that, as long as you have time to wait it out, you still got a pretty good valuation on some things.
And then you've got to decide what type of recession we're talking about, too, I guess, because they're not all created equal. And this could be unprecedented in terms of how quickly we went into it and how quickly the market sold off. And maybe we don't have a V. Maybe we don't even have a U. Maybe we have a W. Maybe we have an L. I'm glad that we have letters that are shaped that way, because those scenarios, you can describe them pretty well with those scenarios. But, it's not necessarily one of those structural recessions from things heating up too much and the Fed tightening and the kind that we've been used to in the past. This is because of the virus solely. And I don't know, whether it should be defined classically as a recession or as a really quick break and then a quick move back up. So it depends on that, too, doesn't it?
It does. And I think what we also have to remember is that this pullback and this economic sudden stop is part of the cure for the real cause of this thing. So the virus is the cause here, and part of the cure is that we had to inflict short-term pain. We had to purposely stop the economy in order to slow the spread and in order to save lives. And that's, again, why you can't separate the health data from the economic data. The good news is that it wasn't a market force. It wasn't necessarily an economic force that took us to this point. So hopefully, and we're hopeful, that there isn't anything structurally wrong with the economy, and hopefully there isn't too much vulnerability in the market that the Fed can't come in and backstop, that this ends up being a really long-lasting recession, even if we do get into one. So right now, best case scenarios are a deep V, so a bigger V than I think we originally thought earlier in January and February, or a U. But the other good news with that is that both of those cases mean that we return to previous levels and we recover fully.